a crowded trading floor in the 1920s, a dark office in 2008 illuminated only by a glowing Bloomberg screen, modern, sleek hedge fund war room with multiple screens and AI dashboards. 1929, Joseph Kennedy. 2008, Michael Burry, John Paulson. 2020s, modern hedge funds and billionaires. Every accident is seen as a shock by the public. But for a small group of investors, the business model remains the same. They have been using the same tactic for 100 years. The merchants were shouting. Paper tickets were flying in the air. Everyone was rich on paper. Everyone believed that the party would never end. But there was a man walking towards the exit. Joseph Kennedy was quietly selling his spot while the band was still playing. Months later, when the market crashed, he was not only safe, he was in a position to profit from the wreckage. Back to 2008, a deserted office, fluorescent lights. A doctor-turned-fund manager named Michael Burry flipped through lines of mortgage data that no one bothered to read. He saw what the rest of Wall Street was unwilling to admit. The foundation of the housing boom was rotting. He doesn't ride the bubble. He bets on its destruction. While TV pundits cheered record home prices, he paid millions of dollars in insurance to cover a crash that is yet to happen. Back to the 2020s, a truck driver was watching the news anchors say, "The market is at an all-time high again." A teacher checks her retirement application and sees bright green text reading "Plan on 23% this year." On their phones, memes and AI names flashed alongside rocket emojis. But miles away, in glass towers and dimly lit hedge fund offices, a different story was playing out. Billionaires cut their stock holdings. Company insiders are selling shares at a rate not seen since the last crisis. Big funds have quietly hoarded cash the size of a small country. Volatility bets are starting to appear in the options market like the early tremors before an earthquake. The narrator asked, "If all accidents were unexpected, why do the same type of investors get richer every time this happens?" The screen freezes on a slow-motion image of a candlestick chart peaking and then starting to fall. Then comes the reveal. Text appears on the screen, line by line. 4-stage, incident profit model, early exit. Sell quietly near the top and keep cash. Buy volatility insurance. Options, swaps, and hedging profit when others panic. Short the weakest sectors. Target the most fragile structures in the system. Buy hard when fear is at its highest. Buy property at bargain prices. Regular investors will take advantage of this bubble and go all the way back. Smart money follows a different scenario. A 4-step model emerged in 1929, 2008, and is now being quietly reset. In this movie, you will see how this 4-stage model worked in 1929. This incident repeated in 2008. Why is the same situation happening again in our time? What stage of the current cycle might we be in? And what can the average person do to avoid becoming the next victim? The mathematics that burst the bubble, leverage and the crowd, a graph of margin debt, climb slowly at first, then go vertical. A chart of house prices versus income do the same. One line display total market capitalization to GDP, escape history, and fly into the stratosphere. 1929, maximum leverage, 2000. Dot-com valuation, 2007. Housing leverage. The accident did not start with a headline. They start with a number that no one takes seriously. Until it's too late. Simply put, the movie analyzed this issue. Lever, in human language, leverage is just that borrow money to place bigger bets. You put in $10. You borrow $90. You now control $100 in assets. If your investment increases by 10%, your $10 becomes $20. You have doubled your money. If it drops 10%, your $10 is gone. You're done. You don't get a second chance. Now imagine the entire market doing this at the same time. Millions of people use margin accounts. The fund uses leverage on top of leverage. Banks lend against assets that appear safe because they continue to appreciate in value. Everything was working until the price stopped rising. Then, a bad news will trigger selling. That sale would trigger a margin call. A margin call triggers a forced sell order. Forced selling will cause prices to fall. Lower prices will trigger more margin calls. This is not a gentle decline. This is a chain reaction. Fear does not arise when prices fall. The fear begins when people realize they are no longer in control. when the escrow officer decides what they own and what gets sold. Excitement. Everyone is making money. I have to join. Complacency. This time's different. It always comes back. Refuse. Just a dip. Panic. Sell it all. I can't stand it. Hopeless. I will never invest again. We see. A young couple bought a house at a time when house prices were rising. A teacher is watching his retirement account fluctuate wildly. A driver trades options on his phone during his lunch break. Then we cut to the other side. The conference room was dark and quiet. The screen was full of models, not memes. No one shouted. They were not surprised. They were measuring. The crowd moved with emotion. Smart money moves by math, cycles, and behavior. The price chart is just a mirror of that conflict. Main contrasts. Retail investors often enter the euphoria and complacency stage and refuse to sell in the denial stage. Sophisticated investors quietly step off the ride as the line between risk and reward shifts. They won't exit early. The most boring, most important step. A wall with old newspaper headlines from the late 1920s appears in the frame. Stocks hit new highs. Everyone can get rich in the market. The 1929 trading floor was noisy and chaotic. Everyone is in there. Even people who should never be near stock certificates. Bartend R. Bootblack. Hotel Bellboy. All trades on margin. In the midst of this storm, there were some people who saw the wave from above instead of from below it. Joseph Kennedy. Bernard Baruch. A few seasoned speculators. They witnessed another panic 2 decades ago. They recognized this pattern. They found margin debt is insane. Stocks are separate from earnings. People often borrow heavily to get in on the action. They know one simple truth. When people who can't afford to lose start gambling with borrowed money, the cycle is almost over. So what do? They do or not screaming on the street corner. They do or not call ahead on the radio. They sell, not all at once, not much, little by little. They turn paper profits into cash, while everyone around them believes the future will be a straight line. By the time the market peaked in 1929, most of them were liquid. When the final crash happened, the crowd lost almost everything. They lost nothing. And were ready for the next phase. Styles change. Now we are in modern offices, glass buildings, and anonymous suburban buildings. Michael Burry sifts through raw mortgage data. He noticed loans to borrowers without verified income. Interest rates are adjustable and will go much higher after a few years. People borrow new money just to pay off old debts. He doesn't need a central bank forecast. The numbers themselves are a warning. John Paulson studied home prices relative to wages and rents. This ratio is out of whack. Home prices are much higher than people can afford with their real incomes. Both come to the same conclusion. This is not sustainable. It is not a question of if, it just broke when. So they exit the transaction by consensus. They stopped considering housing and related stocks as safe long-term investments. They reposition their capital toward a world where prices fall, not rise. They look wrong for a while. They miss the late cycle growth phase. Friends and competitors called them early, negative, even crazy. But phase 1 isn't about looking good right away. It's about surviving what comes next. Now, back to the present. A modern edit. The stock trading app will flash green pieces of paper when you buy. Influencers often talk about stocks only go up and you're stupid to hold cash. AI themes. Big tech companies and speculative names all surged. And in management records and internal reports, another pattern quietly emerged. CEOs sell large amounts of their shares. Founders are diversifying away from their core businesses at record rates. One of the world's most famous value investors is sitting on a mountain of cash instead of stocks. Hedge funds raise cash explicitly for difficult opportunities. It doesn't feel like a crash. It doesn't look like panic. It seems like nothing. But deep down, big investors are reducing their risk, while small investors are doubling down. Storyteller. Phase 1 was never a trend on social media. It doesn't come with sensational headlines. It was just a slow and silent transition, from risky assets back to cash, from many latecomers for the few who arrived early. Phase 1 is where the next 3 phases can take place. You can't buy insurance without cash. You can't short effectively if you don't understand what stage of the cycle you're in. You can't buy extreme fear if you run out of money when the fear hits. While the crowd asked, "Should I buy this sauce?" the intelligent person asks another question. Why is everyone so sure there is no cliff ahead? We move on to the option pricing screen. Numbers are written in small font. Greek. Implied volatility. Most people will skim over it, in confusion. What is variable insurance? Instead of buying stocks that are going up as the party continues, you buy that contract explosion in value when the party is over. These could be put option, a contract that increases in value if the stock or index falls below a certain price. VIX call. Betting that volatility, the fear index, will spike. Credit default, swap insurance. That pays out if a bond or loan defaults. Tail risk hedge, specialized strategies designed to profit from rare and intense moves. You pay a small, steady fee at the beginning. Every month you bleed a little. But if something goes wrong, those contracts can be refunded, and times, 100 times or more. On the screen, we see a simple animation. A flat red line that slowly goes down, small loss each month. This is followed by a vertical green spike as the impact occurs. Back to the 2000s, Michael Burry has restructured his fund. He spent years paying premiums for credit default swaps tied to mortgage bonds. Each month, investors saw losses. They complained. They threatened to withdraw their money. They said he was throwing away what he had returned. Not only was he early, he looked unwell. But Burry understands phase 2. Insurance seems silly until the building catches fire. John Paulson did the same thing. He built a fund whose sole purpose was to profit when subprime mortgages went bust. He bought a large amount of credit default swaps. He lost his insurance in 2005. He had a hemorrhage in 2006. Then 2007 came. Default value increases. Confidence was shattered. The prices of those bonds fell. These swaps yield huge profits. Years of small monthly losses will be rewarded with a burst of profits. Now let's move on to the modern world. We see the buy-sell ratio is higher than normal. Unusual increase in large institutional put option buying activity. The rise in credit default swap prices is tied to weaker commercial real estate and corporate debt. Interviews where a few veteran investors calmly talk about hedging against downside risk, while the crowd just talks about the next hot stock. Storyteller. Stage 2 is the most psychologically painful step in the model. You have to pay to come early. You look paranoid. You are mocked. And month after month, nothing happened. Until suddenly, everything happened at once. And when that everything comes, we enter stage 3. But before we dive into this, remember this. The crowd only began to worry about protection when it was too late. Smart people will start buying insurance when they don't need it. A group buys insurance. Later. The fire had spread to their front door. The other group bought it when the house was still perfect. Only a group of people survived the fire unharmed. 2 kill zones, when the smart money starts to sell underwear. This is where the profit model collapses into brutality. Precision replaces patience. Emotion is eliminated, replaced by pure structural analysis. Smart people no longer ask, is the market going down? 3 underselling, fragile industries. The film moves to 2007. Bloomberg terminal flashes. The mortgage tranches that appeared on the screen. BBB, mezzanine, synthetic CDO. The chart shows that delinquencies are on the rise in Florida, Nevada, Arizona, and California. Storyteller. Phase 3 is not about cutting everything short. It short-circuits the structures that are most likely to collapse first when pressure is applied. We meet Michael Burry again. He's not just betting against the housing market in general. He was reading the detailed terms of each individual mortgage group. Adjustable rate mortgage with preferential interest rate. Borrower has no verified income. Loans are risky. He found the worst of the worst. Loans are mathematically guaranteed to fail when interest rates are reset. He bought protection on those particular batches. When they fail, he doesn't wait for the whole system to collapse. His business exploded immediately. Then we see John Paulson. He went one step further. He not only identified the connections, but companies holding bonds. Lehman Brothers, Bear Stearns Bank, Washington Mutual Insurance Company, the giants of Wall Street, the companies everyone says are too big to fail. He studied their balance sheet. He compared their assets with their liabilities. He saw them as walking corpses with lavish headquarters. And while the public called them rock solid, he quietly cut them short, one by one. Lehman collapsed, Bears collapsed, Washington Mutual collapsed, shorts profited, billions, not millions. 3 of today, the model shows what is now. The film cuts to a modern office with empty cubicles and withered plants. A for rent sign hung crookedly on the glass door. Commercial real estate, 2024 to 2026. If 2008 was the year of subprime mortgages, then the 2020s could be the year of commercial real estate. A simple graphic showing the numbers. Office vacancy rates are rising on 50% in big cities. Remote work changes needs forever. The recapitalization wave is coming. No interest rate. Buildings that are worth less than the loan amount attached to them. This is not a decline. This is a demographic, cultural, and financial change. Buildings bought at 3% interest rates now have to be refinanced at 7 to 9%. That math is wrong. It can't work. So what happened? The owner left. They give the keys to the lender. Default spread. And who holds the loans? We went to a small regional bank. Not flashy, not well known, but deeply exposed. A new graphic appears. Regional bank exposure to CRE, 20%, 30%, 40% of loan portfolio storyteller. In 2008, the problem was inherent in mortgage-backed securities. Today, much of the risk is sitting dormant in regional banks. We see failures. Silicon Valley Bank, 2023 Signature Bank, 2023 First Republic, 2023 New York Community Bank, on the verge of collapse by 2024. These are early warning shots, earthquake tremors. Smart people see this pattern. They know that banking crises rarely happen all at once. They come in waves. So what are hedge funds doing now? The film focuses on short-term interest rate data. Banks that invest heavily in commercial real estate are starting to show up on the screen. Short-term interest rates spike, 20%, 35%, even 50%. Hedge funds are positioning, just like 2007, not shorting the market, short the weakest ships. What causes structural defects that invisible to the public? 1. High leverage in private equity portfolios. Companies bought at high valuations are now having trouble paying off debt. Interest costs are soaring, defaults are rising. 2. Zombie companies. Companies can only survive by issuing more debt. They cannot refinance at current interest rates. They are mathematically certain to fail. 3. The decline in consumer credit card balances hit record highs. Savings fell to pre-pandemic lows. Crime increased. 4. Decouple technology valuation from earnings. Some AI companies trade at 50 to 100x revenue, not earnings. A repeat of the dot-com mentality. 5. Bond portfolio is sinking. Banks still hold long-term bonds bought when interest rates were near zero. Those bonds have lost 20 or 40% of their value. The losses are still hidden on balance sheets. When stress is applied to a system, it is not the strongest structures that fail first. Those are the people who have already bowed. Phase 3 is betting on those who tend to lean towards the other side. Debts to pay. Parts that cannot withstand stress testing. Smart people do not pray for failure. They prepare for the mathematically inevitable, the psychology of poor selling, why most people can't do it. The film changes tone. We see a retail investor watching a falling stock price chart. Their faces became tense, their hands were shaking. Short selling seems unnatural to most people because we are programmed to think that everything is going up. We associate decline with loss. We fear being wrong or negative. And short selling is brutal. If you come early, you will lose money. If you are right too soon, you look foolish. If you are wrong, you can lose unlimited amount of money. The stage requires something most investors don't have, the ability to bet against the crowd and endure silence before the crash happens. Smart people are comfortable in that silence. They don't need confirmation. They don't wait for newspaper headlines. They act on structure, not emotion, because they know what happens next. 4. Buy with maximum fear. The screen goes black. Heartbeat once, twice. Then there's a montage of videos. 1929, prices fell by 80%. People panicked in the streets. 2008, stock price board turns red. Banks failed. Foreclosures exploded. 2020, the entire market froze in just a few days. Oil prices fall to negative levels. Fears rampant. In 1932, when the market was at a historic low, Kennedy bought stocks trading at a price lower than the cash they held. He buys real estate at rock-bottom prices. He buys businesses at liquidation prices. His wealth increased, not in boom times, but in desperation. Buffett bought stakes in Goldman Sachs and Bank of America in deals that would later generate billions of dollars. He bought stocks that tripled and quadrupled in price when the panic subsided. Bill Ackman was paid out $96 trillion on his accident insurance. The market crashed. He was very aggressive. His fund delivered some of the best returns in the industry. When unemployment spikes, when newspaper headlines predict disaster, when friends say, "I will never invest again," that's when the cycle resets. That's when the next generation of assets is created. And that's when the profit model collapses and becomes almost unfair. The rest fall to the bottom with fear instead of capital. They are forced to sell instead of buy. They become a source of motivation for others' recovery. Where are we? 2024, 2026 position and cycle. Fade chart with ominous music. Insider selling at 2007 levels. Margin debt near historic highs. Commercial real estate defaults on the rise. Regional banks under severe pressure. Valuations last as long as the 2000 yield curve inverted for more than 18 months. Storyteller, we are not predicting a specific date. We are defining a model, a pattern that seems disturbingly familiar. 1. Insider selling? Check. 2. Hedging against rising volatility? Check. 3. Short-term interest rates target vulnerable sectors? Check. 4. Huge amount of cash waiting to be deployed? Check. We may be in late phase 2 or early phase 3. The storm has yet to hit, but the clouds are forming exactly as they have before every major recession in financial history, because not everyone can win this game. Most can't. Ethics and power. Who benefits from this model? Is this how the market naturally works? Or is this a built-in asset transfer mechanism? We consider the winners. Hedge funds, billionaire organizational insiders, giant private equity firms, investors can raise capital before the crash. They won because they have the data, they have the tools, they are disciplined. They have cash reserves. Then we see the losers. Small investors, latecomers, people with limited savings, employees with 401ks. Invest heavily in stocks. Anyone who believes that stocks always go up. The last 3 spins, when the system resets, and a few rewrite the future. The film has a heavy and ominous tone. There is one final stage, the strongest, the most brutal, and the most misunderstood. Buy when fear is extreme. But first we need to understand why this pattern continues to emerge generation after generation, and why almost no one outside the inner circle benefits from it. Why the system is built for the copper pattern. Because leverage always increases in good times. Regulators loosen up. Borrowers will borrow more. Investors will take on more risk. Optimism turns to confidence, then arrogance, then blindness. This is not a conspiracy. It is a structural cycle. Humans repeat the same emotional scripts: euphoria, denial, panic, despair, reset, while modern financial architecture exaggerates each stage. The market will reward greed in the early stages. Everyone feels smart. Everyone feels rich. Everyone feels safe. The market will destroy the impatient and unprepared in the end. Margin calls wipe out the retail industry, forced to sell in batches. The mechanical liquidation process is faster, and the only people left with cash are the ones who are prepared. Before, that is obvious. This brings us to the final action. The moment of maximum fear, what it really looks like. 1929, people crowded outside the bank. A stock price monitor kept giving lower and lower prices. 2008, Lehman employees leave headquarters with cardboard boxes. The radio host said in a trembling voice, 2020, traders wearing masks on the NYSE floor stared at screens in disbelief. Oil prices are negative, a condition in which nobody wants to buy anything. Everyone wants cash. Banks stop lending. Newspaper headlines predict the end of capitalism. Politicians appeared on TV looking pale and exhausted. "We have never seen anything like this," the CEOs said. "This is the moment in every crisis where reason breaks down and primal instincts take over. It is where fortunes can be erased forever or created with a single act of courage." How Great People Do Stage 4. Joseph Kennedy, 1932. The market has fallen by almost 90%. Factories are empty. Homes are being foreclosed on. Businesses are selling assets at rock-bottom prices. Kennedy entered quietly without emotion. He buys real estate. He buys companies that are in trouble. He buys stocks trading below liquidation price. He didn't buy it because he felt like it. He bought it because the math made sense. And as the recovery came, his wealth multiplied. Warren Buffett, 2008-2009. The financial system is collapsing. Governments are fumbling. Investors are terrified. Buffett wired $5 billion for Goldman Sachs in one fell swoop. He negotiated high-yield preferred stocks and stock warrants. This was a deal he could only force in a panic. He did the same with Bank of America, and he accumulated shares that were trading at generational lows. A decade later, those positions were worth tens of billions of dollars. Bill Ackman, 2020 pandemic fears. Whole industries are shutting down. Markets are falling at record rates. Ackman received a 96-to-1 payout from his accident insurance and immediately allocate cash into blue-chip stocks at the lowest prices. His fund had its most profitable year ever. Where do we stand now with the proposed model? We see a modern collage of flashing warnings. Insiders selling at 2007 levels, margin debt nears all-time high, commercial real estate collapse. Regional banks are suffering from unrealized losses, office vacancy rate reaches 50% yield curve, inverted longer than any time since the 1970s. Company earnings differ from stock price speculation about AI mirrors the dot-com boom. Maybe not all at once, but enough to suggest where we are in this cycle. Most signs indicate meaning. Insiders have sold. Hedge funds are buying insurance. Short positions are forming in weak sectors. The growing pile of cash. The last shoe is not dropped yet. What can you do if you are not a billionaire? This is not advice. Those are the principles of survival, based on history, based on samples, based on logic. 1. Avoid leverage. Margin turns a small decline into a forced liquidation. Don't be a profiteer for Wall Street. 2. Keep more cash than usual. Cash is not an investment. It is ammunition for the bottom part. A cash ratio of 20 to 40% is reasonable in uncertain times. 3. Consider simple fences. You don't need the complexity of a hedge fund. Even simple put options can provide protection. 4. Make a panic shopping list. Write down the stocks or sectors you would buy if they fell 50%. When an accident happens, you won't be able to think clearly. Get ready now. 5. Don't follow the crowd. If you feel excited, it's too late. If you feel scared, maybe you're still early. If you feel lonely, you're probably right. Is this model ethical transformation? Fair? We return to the moral weight of the model. The screen displays two images. Left, the hedge fund office was bright at 2 a.m. Analysts are running simulations. Positions are hedged. Risk map. Right, a middle-class family is watching the news. See their pensions reduced, feel helpless. This is not a conspiracy. It is structural inequality. Those who understand this cycle and have the tools to win on the way up and win on the way down. Those who do not suffer losses. This is why the four-stage model seems almost like a predatory model. It's not that investors cause crashes. It's that they know how to harvest them. Financial markets are not built to be fair. They are built to be efficient. And efficiency has no loyalty to the small investor. Sign up to follow the next chapter in this hidden finance book.